Could a single meeting change how banks lend and how investors value risk? The Fed's March 26 outreach session might quietly reshape the rules that drive costs, credit, and compliance across the system. Here's the context. Every 10 years, federal banking agencies must review their rulebooks under the Economic Growth and Regulatory Paperwork Reduction Act, or EGRPRA. This cycle, the Federal Reserve Board is hosting a hybrid public meeting. It's separate from interest rate decisions, yet it can still influence bank supervision and the flow of credit. The goal is not blanket deregulation. It's to test whether current rules remain effective, proportionate, and up to date. Think about what's on the table. The review looks at applications and reporting, capital and liquidity, day-to-day operations, and community development requirements. Agencies ask whether paperwork and compliance layers match the benefits. They also consider where definitions need clarity, where forms can be streamlined, and where outdated rules no longer fit technology or market practice. The outcome could simplify filings, remove redundancies, and still protect safety, soundness, and consumers. Participation is broad by design. Banks of all sizes can speak to real costs and operational friction. Community groups and consumer advocates can spotlight access to credit and fairness. Small business owners and borrowers can describe how compliance filters into loan terms and timelines. Academics and policy analysts can bring data and perspective. The hybrid format widens access, so more voices can weigh in from more places. Feedback matters. Comments from the meeting and written submissions help staff decide which areas to prioritize. They shape the burden analysis, the evidence behind potential changes, and the drafting of proposals that could move to formal rulemaking. This is an early step, but it's where the agenda gets set. Why investors should care is simple. Compliance affects bank expenses, balance sheet choices, and risk management. For smaller banks, reporting and exams can influence business models and local credit supply. For larger institutions, clarity on capital, liquidity, and operational risk guides how they allocate to loans, securities, and market making. Streamlined rules may lower costs and reduce uncertainty. Targeted enhancements can strengthen oversight and durability. Your practical takeaway? Watch the themes that surface on reporting burden, capital clarity, and digital era operations. They signal where costs may fall, where constraints may tighten, and which business lines could gain or lose momentum. Read the full article at finlitica.com.